so far. Well, let's see if the trend is your friend with those numbers. And let's speak with David Dietze, founder and president and chief investment strategist at Point View Wealth Management, speaking to us from Summit, New Jersey. The trend is your friend. Will that, be par for the course for the rest of this year, David, with the NASDAQ the outperformer?
Well, so, of course, as we know, all trends continue on until they don't. And I think the real question for investors here is whether some of the trends that you've just been alluding to, particularly the stay-at-home technology plays, the ordering everything online, doing everything you can at home, will they continue, or will the economy ultimately get past what's going to be the worst downturn in the post-World War II era? Will it get past that on the strength of the $6 trillion in monetary stimulus that central banks around the world have laid out? Plus, of course, developments on the healthcare front, where we've seen, for example, Moderna have a very, very limited trial, but some hope that a vaccine may be sooner rather than later. And, of course, we are having here in the States a gradual reopening. All 50 states have taken some steps to get back into business. We're, of course, looking very closely at the news to see whether that engenders any kind of hot spots. And, of course, the two other things that we're watching very closely this weekend is President Trump has made some comments. One is there's some sort of support that is developing from him in terms of another multi-trillion-dollar stimulus package that the Dems are proposing, which would, of course, help, among other things, hard-hit states and local jurisdictions. And, of course, he's also taken a little bit more side on behalf of Hong Kong and talked about perhaps supporting measures to be taken to push back against what China is doing apparently in Hong Kong.
Well, on that note, David, do you think that America or U.S. equities will be the clear winner out of this confrontational relationship? Because if you rewind a year, with Donald Trump digging his heels in with a trade war with China, it was really Chinese equities that were the losers, and U.S. stocks raced to record highs.
Well, never bet against the U.S. consumer, which seems to be the little engine that could. And, of course, Jerome Powell talked about what he was willing to do and said never bet against America. So, unfortunately, I think both countries will lose, but China perhaps has more to lose because, of course, the United States is a far more diversified economy and so forth. We are cautiously optimistic here in terms of our advice to our clients. I mean, we think that tensions are going to be an increasingly part and a headwind going forward. But once we get past the elections in November, our guess is that those will abate a little bit. A little bit of the tensions is a little bit of political posturing. As you know, there's a very tight race here between Biden on behalf of the Democrats, the putative nominee, and Trump. And, of course, you get people out to the polls if you can stir up problems with your enemy.
David, I want to pick apart this geopolitical tension between the U.S. and China, because last year, the one thing that didn't happen was Boeing did not get embroiled in that trade war. But I noticed from your notes you like Boeing. Is there a chance, if this gets any worse, that they'll get caught up in this fight?
Well, absolutely. It's a risk. I don't think it's the number one risk. The number one risk, of course, is that most of their business is producing airplanes for the airlines, and no one wants to get it on an airline right now. That's their number one problem. The second problem is, of course, they've got to get past the 737 MAX. A third problem, of course, that China is a big customer. Of course, we just saw a terrible crash by an Airbus plane on Friday in Pakistan. So certainly no one wants to just have a single monopoly in terms of any one company being the sole supplier of aircraft. So I think longer term, I don't really see that as an issue. I think that the key issue is to get the economy going again and basically to build consumer confidence that they can get on a plane and not get sick. And then we're back into the healthcare analysis.
Looking at the rest of your recommendations in terms of stocks, you seem to be an advocate of a catch-up play insofar as, perhaps the energy industrial cyclicals may not have been fully valued or acknowledged in this rebound we've seen across tech. Tell us why you like energy and Chevron.
Sure, absolutely. So, energy, of course, as I said the other day, fossil fuel prices now at $32 a barrel. up $80. As you know, in April they went negative, so it's the worst crash that we've ever seen, but that has reduced and taken a lot of supply out, plus of course the Saudi Arabia has lifted prices up and so forth. So I think oil is probably your best proxy for a rebound in the global economy, and a lot of that is going to depend on China because they're the largest importer in the world. We're starting from very, very low prices. Of course, oil was above $60 a barrel. Now it's 32. It's looking attractive. So why Chevron? Chevron is your bluest of your blue chips, has a strong 5.7% dividend. It's committed to not only maintain it, but to grow it, is very well diversified. So I think that's going to be the first stock that non-energy investors will invest in if they want to participate in the rebound in the sector. Remember, since March 23rd, which appears to be the bottom, energy stocks are up over 60% versus just 36% for tech. So it's a story that hasn't yet quite caught on, but it will soon be learned.
David, we've got to leave it there. I really appreciate you coming on your Sunday to talk to us, and enjoy your long weekend there stateside, what's left of it. All right, that was David G. Dietze, founder, president, chief investment strategist at Point View Wealth Management. We're going off for a quick break. Stay with us in Asia First as we roll into our second hour this Monday morning.